Emergency alert, major trade alert coming next Thursday after a historic CPI print is released at 8:30 Eastern. We'll talk about the moves we're going to make in the portfolio later, but let's look at how we're currently positioned. We're getting ready for a market melt up. Money printing pivot has begun. Bank of England pivoted most recently. Bank of Japan has been doing it for months. China is now beginning to print money to protect their currency. And Australia just came in with a dovish surprise, and Poland. Our high risk portfolio has a total return of 27% year to date, which is amazing when stocks and bonds are down over 27% year to date. Our high risk portfolio is up 7% total return just in October. And our safe growth strategy, which was having a rough month last month, is making a comeback hero with a 20% gain to start out October. So last year, our total return on the high risk portfolio was 233%. And we're using a very similar strategy for what's coming up next. Now, this year's all been about the Fed wrecking the world economy so that we can export inflation. So the US had this massive inflation problem from printing too much money and wrecking supply chains with a global lockdown. And so the strategy to get the inflation out of the US was to make the dollar go up so that the US purchasing power was going up against foreign currencies. And this has had a devastating effect on Europe and Asia. Now we're actually expecting the exact opposite to come through for the next 2 years. So what worked well last year and into this current return, we're actually looking at about the exact opposite to begin developing. Let's take a look at our risk calculator. If you're a paid member, you have access to this calculator. And what you do is you type in the total to invest, and it breaks down how many shares of each ETF to purchase. Now, all our members are following a ratio of shares, not an asset allocation target. So right now, one unit comes in with 19 shares of UVXY, 36 shares of TMF, 14 shares of EUO, 57 shares of ETHE, 27 shares of FNGU, and 1 share of NRGU. The top 3 are defensive or deflationary assets. The bottom 3 are offensive or inflationary assets. So if the CPI this Thursday comes in weak, in other words, inflation is falling, we're going to want to dump that EUO position and perhaps even trim down UVXY and load the boat into oil and Ethereum. So a lot to cover here in the next hour here. Now in our safe growth strategy, we're loaded to the brim in stocks. We're good to go. If the CPI comes in weak, that portfolio is going to rip higher. We have a few adjustments to simplify it coming up, but that's really what we're looking at. Now, if the CPI comes in hot, too high, then the high risk strategy is set to jet. We're already very defensive, and the safe growth strategy will need to react. Now, if you're not a paid member, there's 3 spots available per day at special pricing if you call Dean at 505-322-7515. Call him now to learn more about our 2 programs. Okay, so let's go through the trade alerts one by one. And I'm going to start with the most exciting ones where I think you're going to make the most money in the shortest period of time. So first of all, the setup for oil is beautiful. It really couldn't be any better. Especially if you're betting on US oil and gas companies, the big ones that are buddies with Mr. Well, we got to be careful about words we say, we'll get censored. So we all know who, but NRGU is leverage times 3 with the top 10 US oil and gas companies. And I believe they're about to have record profits here. So we're hanging on to that position. It's been delivering massive gains this week. So what's developing? Well, in general, the war is escalating. And so we had all this footage this week of Russia essentially preparing for nuclear war. And that's what this is talking about in this thread. Now, I don't expect them to attack first, but really rather to be ready for a response. So this is ahead of potential sanctions price capping Russian oil, which they've said they will respond by simply not selling oil to those countries. So the net effect is going to make oil go up if they try to price cap oil. The other big factor that's been keeping oil down is the people in control of the US, we won't mention names, have been dumping the Strategic Petroleum Reserve at the fastest pace in history to levels not seen since the 80s. And this is going to end in several weeks. This is all being done to get the inflation to go down, gas to go down, to help put certain people into power with the midterm elections coming up November. And so that catalyst is about to end. Meanwhile, OPEC and Russia just teamed up to drop the supply by 2 million barrels a month. So all of this added up is going to send oil back to over 100 unless there's tremendous demand destruction. The White House is very upset about this. So right now we're long NRGU. I might put Boyle back into play. So we made a lot of money on Boyle twice this year, which is betting on the price of US natural gas going up, which is currently trading at a dramatic discount compared to the natural gas available in Europe. And so what's been interesting, when we had Nordstrom blown up last week, and all this fear of Europe essentially being cut off of gas, what we noticed was Boyle kept crashing lower and lower. Now it's been bouncing a little bit here. I think it's going to be a very beautiful time to get long again, most likely Thursday. This is a great thread that essentially explains why electricity prices have been coming down so aggressively as the war is now escalating. And so this fellow, Andres Steno Larsen, had been warning that the market had really leveraged up and speculated energy prices to very high levels. That didn't make sense, and that's all getting wiped out. And essentially, here's a look at the German electricity spot going from 500 down to 200, but he believes it's going to bottom out. And here's what is important. The EU began to conserve gas and front load and fill up all of their inventories. And so here you can see the levels are quite high at almost 100% in all these large countries. But the catch is what's happening now is all the natural gas is getting shut off through Russia, through Nord Stream 1 and 2, and we're about to go into the cold season. And the primary driver of electricity for the next year is still natural gas. So he believes these reserves are about to fall and that you should essentially be buying the dip here. And this is looking at the supply of gas getting crashed dramatically over the last 6 months. So Boyle, the US LNG play, could have another epic rally here. So we're getting ready to potentially put that into play as soon as next Thursday. Now, this is just looking at the natural gas prices relative to electricity prices. You can see they're extremely correlated. The higher those prices go, the higher electricity goes. So we actually thought OPEC was only going to cut by as much as 1.5. They came out announcing that they're probably going to do 2 million barrels. So no cheap oil anytime soon. Peter Sutherland says the oil demand is weak. Crowd is about to get a nasty surprise come mid-December when SPR, GCC, and Russian barrels all drop off just as gas to oil switching ramps. It's a cliff event and market is sleepwalking into a supply shock. Okay, so other headlines, we're now up to 85 billion in aid to Ukraine. And what's this all about? What I've come to believe is it's a 3-part strategy by the US. One is to weaken Germany so they're not reliant on Russian energy, or to partnered with China. So they've done it. We've collapsed the German economy. It's going into a deep recession. That's part one. Part two, and in general, this is so the US can maintain control over Europe. Part two was to isolate Russia. And I think they would like to collapse their economy and control out of Putin's hands so they can take over these key commodities. So you can see they have key commodities across the board. And that's what a lot of this war is about. And then 3 was to set back China so that they're unlikely to expand their 5G network via Huawei nor take over Taiwan to get the Taiwan Semiconductor company, which has the most important chip manufacturing company in the world. And so far, it's working in spades for the US. It drove the dollar up, letting us export our inflation at the expense of the rest of the world. Now, when will Putin stop this invasion? Peter Zahan believes long term, he wants to take over all of these countries to really fortify Russia's position. So we could be at the start of a potentially multi-decade war. So we'll see how this all plays out. NRGU, here's the play. We were holding on to it at 550. We almost sold it, dropped to 300. I'm sure most of us were wondering where the bottom would hit, and now it's shot back up. And I believe it potentially could go to new all-time highs if the Fed pivots, because that's the main mechanism for demand destruction on oils, for the Fed to keep tightening. So we'll see what they do Thursday, but the outlook for NRGU headed into the next few months is beautiful due to the supply side shrinking dramatically and more sanctions potentially going into play. So these are the big companies we have exposure to, leverage times 3. Don't forget, Buffett owns almost half of Occidental Petroleum now. Here's that oil chart. So it came down and making a sharp bounce. Now, if the DXY is going to fall, that could alone send oil back up. This is going to be a big problem for the Federal Reserve, who's trying to fight inflation currently. And we can see that big downtrend over the last 3 months, which was helping the inflation come down. Here's Exxon, so one of the key companies here, and we can see they're at levels we've not seen since Mr. Obama was president. So again, is this about to break to new highs? If oil is going to stay above 100, I would say yes. And here's that chart of Exxon just skyrocketing up here from 84 up to 98.87. Okay, so that's our energy play. Right now we're long NRGU. We probably will add back Boyle, and we'll see how we get around to doing that come next Thursday, assuming the CPI print is soft. If the CPI print is really hot, in other words, it's flat or going up, and then I actually think energy is going to be hit hard by very aggressive Fed, and we would want to get more long EUO, the dollar, and also UVXY. Okay, so crypto, buy 57 shares of ETHE, the Grayscale Trust that gives you exposure to Ethereum safely from your stock brokerage account. You don't have to go to Coinbase and risk getting hacked. We believe this is the ultimate growth asset. Now, the bigger market is, of course, Bitcoin. I believe in the next 2 years, Ethereum has a great chance of catching up to an even market cap of Bitcoin, which means it could outperform Bitcoin at least 2 to 1. Now, here's some just interesting stats on why you may want to be getting long cryptocurrencies right here. And it's very exciting because they've been less volatile than stocks and currencies over the last few months, front running what's expected to be a weakening dollar and falling interest rates over the next 2 years, which would be extremely bullish for these assets. 62% of Bitcoin has not moved in over 1 year. Name another asset where holders refuse to sell after a 72% drawdown. This is looking at GBTC, which we have in our safe growth asset. And assuming the discount window can be reduced, there's a 35% discount against the NAV. That means you're buying Bitcoin at 12,590 when it's worth 19,435. Now, again, a big assumption that that discount window can be closed. Now, I do want to mention sometimes GBTCs trade at a premium. So if we got into a bull market where it has traded at a premium, not only could it reduce that 35% discount window, it could actually jump over it. And that's a big if. So we'll see how that plays out. Now, here's what I show investors to get them bullish on cryptocurrencies. The last big melt up had very similar characteristics leading to it that we're currently sitting on, except I would say it's about twice better today than it was in 2015 and 16 that led to this melt up all the way into 2017 and 18. And so what we had was a collapsing Chinese real estate market, which we have now, and it led to essentially Asia's currencies weakening against the dollar, especially Europe's. And this sent the DXY index to 103. Now, we've seen it hit 114 in this chaotic mess, but just getting it to 103 by the start of 2017, once the contagion was contained. The DXY fell from 103 to 92.5, a 10% decline. That small 10% decline in the dollar index, which took only 8 months, skyrocketed Bitcoin by 464%, sending the price from 800 to 4,337. And again, in 8 months' time. And here's that move. So you got to be long to catch the big moves. And when it does move, it can go straight up. Now, as we know, it went way higher. It went to 19,000 shortly after. Let's talk about why. So outside of the dollar, we need to recognize that the US Treasury market has been in severe pain for 2 years now. Today, we have all of Asia and Europe selling US Treasuries and stocks to gain dollars, which they are then in turn using to buy their own currency. The hope is to prevent a further collapse in their currency against the dollar. But the irony is that this is accelerating the problem and has driven the DXY even higher to 114. So try to imagine the move cryptocurrency is about to have if DXY bottoms back out at that 90 range that we saw in the last reversion. It's going to be an epic move, sending cryptocurrencies dramatically higher. So we're expecting interventions to be necessary by the US to essentially protect its own stock and bond market from collapsing. Okay, so what's happening is foreigners are dumping US Treasuries and stocks to protect their currency. To stop this, the Fed must pivot. Otherwise, it's going to get worse and worse and continue to accelerate. And so we just saw Bank of England do this. They're raising interest rates while doing quantitative easing, or AKA yield curve control. Now, looking at cycles, which highly correlate to bond market cycles, this is indicating we're on the precipice of a 2-year bull market that will send Bitcoin to 200,000. So we will see how it plays out, but that's a massive, massive return ahead. And if we do the math, this could potentially put Ethereum at 26,000, starting at 13,000. So just some massive potential gains ahead. So now comparing the previous time to today, again, it's about twice as bad, not only on the dollar index, but also the bond market crash. Back in 2016, the US bond market, which you can watch with the TLT ETF, had cratered from 145 to 120. Now, to put things into perspective, TLT bottomed out at 101. This is an insane level. The last time the market crashed was 17%. Today, we're sitting on a 35% crash that's been going on for about 2 years. It's the worst bond crash in history. Once the problem had been contained, the bond market stopped crashing, the DXY index fell, and you had this massive cryptocurrency rally. So here's the bond market crashing. If the blue line's going down, it means the bond market's crashing and interest rates are rising. Okay, so this happened until about November of 2016, and then it bottomed out and interest rates slowly started to ease. That's all it took to explode cryptocurrencies higher. Bitcoin began front-running the move before the bond market had actually recovered. And even while it was crashing, it was trading flat, just like it is today. And Bitcoin went from $800 to $19,000, or a 2,423% return in only 16 months. And the tail end of it was the most insane move, from 6,000 almost straight up to 19,000. Today, we sit on the longest and deepest crash in the US bond market history, resulting in a 35% decline in the TLT and 114 level DXY. The chances of this being allowed to continue for much longer is low, because it puts the US stock and bond market at high risk of further deterioration at a time when the US needs to raise $1 trillion to cover its expected annual deficit. And at these interest rates, that deficit will grow massively. If these levels are allowed to be sitting at these extremes, we're going to see foreigners dumping US assets, which will put the US into a deep recession. A recession could easily create a deficit that is $1.5 to $2 trillion, because it's going to kill our tax receipts. Okay, so this would be just an absolute nightmare. It would make way too many supplies of treasuries versus demand. So those interest rates would just get worse and worse. So they're trapped. They can't allow this to continue. The key to ending the pain is the Fed, and the Fed must give forward guidance that they believe inflation is falling, that they will be able to slow down rate hikes and quantitative tightening plans. So this print on Thursday at 8:30 Eastern next week will be one of the most critical inflation prints in history. If it's not falling, yeah, look out for potential pain ahead. Now, I believe it will begin falling. We'll look at all the data in the bond market section. But it's almost certainly going to spark a massive short squeeze. And it looks like everybody's front running that this week. We saw the last 2 days, these massive upswings in stocks, barely a move in bonds, a little bit of a VIX crush. And the market is making a big rally. We had a sell-off today, but that was quickly reversed and nearly back to positive territory right now. In general, I'm going to expect a big squeeze in bonds, stocks, cryptocurrencies, and commodities if we get a pivot from the Fed. Drunken Miller says cryptocurrencies could have a renaissance if people lose trust in central banks, which is happening bank by bank as they end up buying their own debt to prevent a credit crisis in their country. Sivan Henrik says, you've reached a unique time in history when Bitcoin is suddenly less volatile than fiat currencies and the bond market and stocks. And that's because they know it's a less liquid market with the smaller market cap. So it tends to bottom out early and make moves to the upside before stocks do. US dollar, your money divided by infinity. The last year, the US did not grow the M2 supply in an attempt to control inflation. Okay, this is the only time it's done this much restriction in dollar printing in its entire history. Okay, the whole system will collapse if they don't keep printing dollars. So bet on it. The US dollar will continue to expand, and this big move in the dollar is likely about to reverse. Now, Bitcoin, you got 21 million, and that's it. Ethereum's even better. They switched to a model that actually destroys Ethereum over time and gives it even better properties than Bitcoin for being rare. Okay, so again, are we too early in crypto? It's been around for a decade, but what's the adoption rate? This chart's assuming that only about a small fraction of the population is actually investing into Bitcoin. So what's happened over time, though, is the adoption speed is much faster. So we could be catching a massive amount of adoption in the next 2 to 3 decades, whereas other technologies took multiple decades to reach this point. Some other signals you should be getting long crypto. The 200-week moving average has only been touched 4 times in history, provided great buying opportunities. RSI has only gone to this level 3 times in history, and were great buying opportunities. We had the worst month ever and the worst quarter ever in its history. Now, Ethereum offers a 5% staking reward with potential 10 times growth. Okay, you're not going to make 10 times your money in energy, which has the highest dividend. So Ethereum not only has the greatest growth potential, it also has a greater yield. So a lot of incentive to buy and hold this asset. Primarily, if you're investing in crypto, you're betting that governments will spend more money than they collect, and that this is going to expand the money supply over time. And you can see in this chart, it's just unstoppable growth of debt. They try to slow it down every so often, and it creates crises, which leads them to growing the debt even faster and faster and faster. So unless there's a major political regime change that lives on values that is to spend less than you make, this is just going to continue. Now here's the U.S. federal budget deficit projections, and you got to realize the voters are not going to vote for anything outside of all this free stuff the government continues to promise and double down on. So we're looking at growing the budget deficit from $1 trillion to $2.3 trillion in the next decade. This chart's just showing you the exponential growth of debt. So what took 200 years to grow 17 trillion in debt took 2 years with the planned lockdown. All right, here's Ethereum over the last year, down 57%. By the dip, you can see it's bottoming and getting ready for the next big rally. Grayscale Trust is down 64. So that's a 7% discount window just this year, where Ethereum ETHE could potentially outperform. Now, we actually recommend, if you're a member, to invest in Rebel dividends. We're going to give you, for every dollar that you normally have in ETHE, I'm going to give you $1.50 to $2 worth of exposure to Ethereum. I'm going to buy the top applications that are being designed on the Ethereum operating system that actually outperformed Ethereum 10 to 1 in the most recent bull market. So you get a much more diversified position, and it's designed to replace your GBTC or your ETHE position. To learn more about Rebel dividends, call Dean at 505-322-7515. It also has a weekly dividend, very popular product. And again, it's only available to members of Portfolio Builder. Okay, next step, buy 19 shares of UVXY, the crash insurance hedge. I don't see a big crash coming unless we are off on the inflation. So I did not expect the core. So headline inflation fell last month, but the core rose. And that's the opposite of the trend we'd seen for the start of the year. It's primarily due to labor and services and rent, which we're starting to see an easing on. So that's the good news. Timing's always the hard part. I believe we're in a topping process in the core that will start to soon fall very quickly. And the Fed's likely going to not give the forward guidance we're looking for until the core and the headline are both falling. This is looking at when the S&P 500 is down 25% or worse in the start of a year, and the year forward is extremely positive. Average return is 21%, and out of 10 instances, only one time was it lower a year from now. So great time to buy stocks, and potentially we've hit a bottom. Here's looking at the 200-day moving average of the Nasdaq. Rarely hits this level. We saw it in 2018 when we tried to do too many rate hikes, 2019 and 2009. All of these were beautiful buy the dip opportunities. And so we'll look at the stocks we recommend shortly. Some more stats. The number of down weeks for the S&P 500 as a percentage this year is 64%. Only time you saw this was in 1931, entering the Great Depression after the Roaring 20s. Number of weeks for the long duration treasuries to be down is 70%. This is the worst we've seen since the hyperinflation 60s. Now, again, we don't have the same dynamics of the Great Depression where we didn't know how to print money, and we don't have the same dynamics of the 60s where we had a rising labor force and a booming manufacturing sector. In fact, we have quite the opposite. So I believe most likely the pain is about over. Now, here's the wealth destruction in bonds, $35 trillion. This is going to make pension funds insolvent. And that's why the Bank of England had to start printing money to protect their pension funds. Now, the financial sector can be very sensitive to potential crashes. It's back to the COVID 2020 level. It hasn't crashed below that. We'll keep a close eye on it. Midterm seasonality is very bullish, about an average return of 20% from the bottom of the year leading into it. Now, are we heading into a recession? Almost certainly, but that typically is the bottom of the stock market because the stock market's looking so far ahead. So stock market sold off, predicting the recession. Now it's starting to bottom out. JP Morgan Marcos Kolanovic says the Fed tilt is becoming, now he has sort of backwalked this after the Nordstrom blow up because he's worried about the inflation being sticky with the war escalating. But we're seeing central bank after central bank flip. Fed tilt becoming increasingly likely, hawkishness creating oversold conditions. Real-time inflation is falling faster than the CPI recognizes because of its components. Also, we've got massive money in put options. You typically don't get the biggest crashes when everybody's hedged, which is currently the situation. So here's UVXY in the March 2020 lockdowns, which sent the SPY down 25% in a month, and UVXY went up 1,000%. So if you had a $100 trading account and you had 10% in UVXY and the rest in the SPY, You lost 25 bucks on the SPY, but you made $100 on the UVXY. So it more than made up for the downside. Here's a chart of UVXY, up 11% in the past month, down 15% in the last 3 months. It really hasn't done a good job this year because it's been a very slow, controlled decline, not a big, sharp crash in a single month, which is what the UVXY would do well with. This is showing all the problems that have occurred every time the dollar index went up this sharply. So it's going to be very important that they get it down. Otherwise, there could be some dramatic problems. Also, if the Fed hikes rates too fast, too far, it has turned into market crashes time and time again. And this is highlighting all the times they've made those mistakes. What it's not showing you is all the times they've pivoted, however, and saved the market, which is numerous times. This chart's looking at some of the bad returns on stocks over the last century. So we've got the World War I wasn't so hot, 19 years of flat markets, led to the roaring 20s, which led to the Great Depression, one of the biggest crashes in stocks, something like 95% crash in a very short period. Now, if you bought the bottom, you made a lot of money leading up to the 60s inflation and 70s inflation rate. It's 16 years of volatility and no returns. Okay, so we're aware of crash risks, and our main threat right now would be the CPI just not cooling off. Okay, so bonds, that's what the inflation's all about. Let's dive into this. This is looking at core CPI relative to household net worth. And so CPI is lagging the net worth. We have just crushed Americans' net worth by $14 trillion in this chart. So if this plays out, the CPI is not just about to fall, it's going to crash. And this will be very good for bonds and stocks, and especially cryptocurrencies. Here's one of the first signs that the Fed will be paying attention to, that the interest rates are working. And that is job openings crashed 1.2 million, the biggest drop in quite some time. We're also seeing a slowdown in the balance of trade. So we're importing less, which shows the demand side starting to slow down. We also have a stronger dollar, so that's helping the US export its inflation. This chart's looking at layoffs, quits, and the job openings per seekers. So it went from 2 to 1.87, 2 jobs per person to 1.87. So we're seeing a little cool off in that metric. Layoffs super low. So we're seeing some signs of a weakening labor market, but probably not quite enough. This Friday, we'll get the non-farm payroll, and let's hope it comes in weak. That'll be very good for a bullish setup. Here's that drop in labor market tightness. Okay, this is comparing ISM prices paid versus CPI. It's also predicting not only that CPI will fall, it's going to fall fast and furious. Again, that's what we'd love to see. Here's the historical bond market drawdowns. Typically what comes after bond market crashes are massive rallies. So we will want to get more aggressive in bonds soon. And again, it's the worst in history. 26 months now with a maximum drawdown monthly of 16%. Peter Schiff says we finally reached the inflection point. Governments can either keep running budget deficits or they can fight inflation, but they can't do both. Plus, they can't win an inflation fight without causing a financial crisis and recession worse than those they caused in 2008. And so all the governments refuse to balance their budgets. So they will have to continue to print money to continue doing so. United Nations calls on the Federal Reserve and other central banks to halt interest rate hikes. Central bank risks pushing the global economy into a recession that could take decades to recover. Lynn Alden says most market commentators are focused on unemployment rates and inflation as the key signals that will determine Federal Reserve monetary policy. However, I continue to view Treasury market disorder as the more likely limiting factor for the Fed's plan on monetary tightening. In other words, with the current tightening plan, there's a good chance U.S. Treasury market or adjacent markets will run into acute liquidity problems before inflation is back to 2% and before unemployment increases. And so with rates this high, that's certainly the issue. But we're seeing it much worse in smaller countries. The savings drawdown is looking quite rapid. So U.S. households had $2 trillion in savings, and they've drawn it down to about 1.4 trillion. So we're going to see demand slow down as that excess savings comes down. But there's still a lot of money in there to keep the economy going for now. Again, we're looking for a slowdown, not a crash, for the way we're positioning. This is looking at CPI, wages, and salary. We had this spike in wages and salary. All our indications that this is about to top out and fall as unemployment rises. Michael Gade says, FinTwit, the Fed won't pivot until something breaks. Bonds, what the F, look at me. Lynn Alden says, UK bonds broke. US bonds are breaking, but not yet broken. Now, another leading indicator is the housing sector. Year over year, the 30-year mortgage rate has had the sharpest rise in its history, and we're already seeing the pain. Assuming you put 20% down and you can spend $2,500 a month, just a year ago, you could buy a $758,000 house. Today, you can only get a $476,000. So those really high-priced homes are going to have very low demand moving forward with these interest rates so high. Case-Shiller 20 City Composite, first drop in prices since the 2008 to 2011 crisis. So prices of houses are finally falling. Here's a look at disorderly market behavior in the Treasury market. Foreigners are having to dump US Treasuries to buy dollars to buy their own currency. And the stronger the dollar goes, the faster they have to liquidate. And that's only going to be resolved by the Fed turning down the hawkishness. More signs of deflation. We've got a big pickup in people looking for unemployment benefits and food stamps. Now, this is showing how unpredictable the bond market is, or how bad the forecasters are. And you can see the dotted lines are always predicting that central banks are going to get these interest rates way up, and they never get anywhere close to that. So I think the rate hikes and quantitative tightening talk are going to be coming to an end in the next 6 months or less. Pending home sales had a 22% collapse. This is equivalent to what we saw in 2008 and 9 and the March 20 lockdowns. So absolutely everything's slowing down. Nomura's McElligott says, we now finally are proving that central banks are trapped into a Bank of Japan-like forever state of balance sheet expansion, as they are once again forced to bend the knee to market forces. They're talking about buying their own debt. This is looking at when the S&P 500 was down significantly and what the bond market did. Most times the bond market protects the stock portfolio. This year, bonds are down more than stocks. And that's what happens when you have too much inflation. The bond market gets pissed. Bond market volatility index move is at an extreme level. Could it go a little higher? Sure, but most likely we're very, very close to the bottom in bonds. And if it did go any lower, the Fed would be forced to activate a massive buying plan to secure the most important credit collateral in the world, the US Treasury market. Here's the liquidity index. And again, there's no liquidity out there. This is all being done to kill inflation as fast as possible and then recover the economy. And Luke Grumman just points out at the DXY at current levels, foreigners have 7.5 trillion treasuries they can sell, and the Fed is supposed to sell about 180 billion a month, and the US has to raise at least $1 trillion. So there's just too much supply versus demand if we don't make rates appear like they're going to fall so that bondholders don't get crushed. This is showing you what happens when the 10 and 2-year yield goes inverted. Typically, it's the peak in interest rates, and you get a collapse in interest rates shortly after, which is exactly what I see coming. Okay, the Zillow rent index, the rate of change is falling. It's still rising, but it's slowing down. Peaked at 18%, and it's currently at 13.2. So this is one of the big inputs. I think it's about a quarter, 25% or more of the entire core inflation print. So here's the inflation print that pissed off the markets last month. Let's hope it's dropping so that the Fed can start to pivot. Otherwise, they're going to crush the global economy and put us in a severe recession. Okay, so here's that rent inflation that keeps going up. We need to see this slow down. It's likely going to keep growing, but we want to see it slow down. Food inflation, another problem for the core, or for the headline, excuse me. Services inflation is a core problem for the core inflation. So those are going to be some of the key things to watch. Here's the Treasury market over the past 3 months with the leverage product, TMF, down 34%. This is like the TLT times 3. It's our favorite way to have exposure to bonds. TLT, you can see, has had these epic crashes, but what happens next? Epic rallies. We're expecting this to quite likely get near the high we had previously. And that's the only way this debt continues to grow globally. Central banks have all sorts of schemes on how they're going to get interest rates negative, and a lot to talk about. But that's the only way they're going to keep the whole Ponzi scheme going here of debt growth. So there's your TLT down 12% in the last 3 months. We're not investing in corporate debt, but LQD is down 6%, and the junk bond market's down even less, 1.5. Here's the 3-month bond going straight up. Again, this happens through history, but what happens? It tops out and then it crashes violently. So the time to buy treasuries is now. Here's the 2-year, same chart. Went way above the recent high. Notice most of the highs hit new lows and don't break through the previous high. So what we're looking at here is absolutely extraordinary and unlikely to maintain. Here's the 10-year, same thing, out of that channel, way higher than anyone thought possible, and why we've had such an ugly market this year. 30-year, same picture. Okay, so we can see the only way they grow the debt over time is to push interest rates to new lows. And you better believe that is the plan over this next several years. Italian bonds, they had a new leader take control over Italy that Europe hates. So they could try to hijack their debt markets by not doing yield curve control over there, which they had been doing previously. So some potential problems coming out of that. Other inputs for inflation, lumber futures have crashed from 1,200 to 400, down 65% year to date. Copper futures are down, still at high levels, but way down from recent highs, down 21% year to date. Baltic Dry Index down 18%. Wheat futures are getting a bid, so food is still running hot. So overall, just about every indicator is showing a slowdown and that inflation is going to begin falling. Consumer sentiment is at a level that's only been seen a few times in history, typically beautiful buying opportunities. Now, initial claims we'd like to be picking up, so unfortunate that that's falling. So still a pretty tight labor market, even though we saw job openings fall. 10-year over 2 years inverted, typically a great signal to go long tech and bet interest rates are going down. Okay, moving to the next section, the US dollar. Okay, if inflation is hot and the Fed's going to keep jacking interest rates, bonds could still trade flat or lower. Stocks are going to get crushed. Crypto is going to get crushed. Foreign currency is going to get crushed, and the dollar is going to continue soaring. So that's where we have a lot of our money parked in the high risk that already has a good return for the year. It's trying to protect that return until there's more certainty next Thursday. So here's the rolling return on cash. Again, typically it goes up and then it drops. So we want to dump that position the second we're confident CPI is falling. The Fed's going to pivot. Ray Dalio, who stepped down as CEO from Bridgewater, I think yesterday or the day before, has changed his mind about cash is trash. A little late, buddy. As John Maynard Keynes is credited with saying, when the facts change, I change my mind. What do you do, sir? Along these lines, the facts have changed, and I've changed my mind about cash as an asset. I no longer think cash is trash. At existing interest rates and with the Fed shrinking the balance sheet, it's about neutral, neither a very good or a very bad deal. In other words, the short-term interest rate is now about right. And again, we believe interest rates about to fall, so that would mean cash is back to trash. China signals massive dollar dump after the yuan loses more than 11% to the dollar. People's Bank of China told major state-run banks to prepare to shed dollars and to snap up offshore yuan. So how do they get those dollars? They dump treasuries, they dump stocks. The US does not want this because it will hurt our tax receipts and ability to service debt. Here's a look at all the countries getting crushed. The only thing up is very commodity-driven countries like Brazil and Russia. Only currencies up against the dollar. Everything else is just getting slaughtered. Here's the dollar index year to date, 20%, 18.9% return year to date. Here's against some major currency pairs. And you can see this is how the US is killing inflation at the expense of the rest of the world. Go America, go. Here's dollar index. I want you to note that as time progresses, debt is getting exponentially higher in the US, and the maximum price of the dollar is topping out lower and lower. So I believe we're on the verge of topping out, and that this is going to fall as interest rates fall. And again, the key to this will be inflation coming down. EUO is up 30% year to date. It's betting that the dollar will go up against the euro primarily and the yen, USD versus in its leverage. So the euro is down 13% against the dollar this year. The yen, who's been doing massive yield curve control to protect their bond market at the expense of their currency, down 25%, and the Chinese yuan is down 11.5%. The ruble is up 24% against the dollar, the only currency outperforming ours. Okay, stocks, buy 27 shares of FNGU. So Twitter's in there having a big bid now that Elon is taking over the company. But it's 12 gigantic monopolistic tech companies that have radical amounts of call option by hedge funds and retailers, and they always outperform their index, almost always. So this is our favorite tech play with leverage times 3. So bad news is good. So we had 6 down days in the S&P 500. This was a chart from Friday, and we got this melt up Monday, Tuesday. This is the green dots showing when you've had consecutive down days that lead to a new 52-week low. Not always the very bottom, but quite often a very, very, very high probability you're going to make money. So with the 1 month, you have a 60% chance of making money, 12-month, 90% chance with an average return of 20% from there. Breadth below this level has only been hit a few times. All the red dots show you that. Doesn't always get the very, very bottom, but it's definitely signaling a good time to start accumulating. So we are at that point. Now, are we going to have a crash where yields go lower and stocks get crushed? Or are we going to have stocks, commodities, everything going up together? I see a pretty healthy economy here as long as the Fed pivots in time. So we can still see consumer spending is rising, balance of trade is shrinking, but still strong. Retail sales continue to grow, but slowing a little bit. Consumer credit continues to grow. Bank credit continues to grow. So we're not seeing some sort of crash. Just a slowdown is all we need. Goldilocks situation. S&P 500 buybacks are going to hit record levels, and percentage of people taking too much risk is at an extreme last seen in 2009. So buy the dip. Over a decade, you'll be very happy. It's showing you the decade returns through the 1900s. So the 30s and the 2000s were only negative returns. Massive amount of people have bought put options. So put options are expensive and unlikely to crash with massive amounts of put option protection. And everybody's been buying it. Midterm years tend to bottom later in the year and see large corrections. 1 year from the bottom, assuming we're at the bottom, the average return in a midterm year is 33%. So we like FNGU. This is trading at 620. It was just at 45 last December. So the potential return on this is massive. Down 27% in the last 3 months, 19% year to date. Now this is similar to the Nasdaq, the QQQ. It's down 27% year to date. Emerging markets are down 25% year to date. In our safe growth strategy, we're playing emerging markets with EDC, EEM times 3. This shows you about every other market cycle, emerging markets greatly outperform US markets. Now, if the index with the DXY index at this level and interest rates at extremes, we have literally the perfect setup for emerging markets to thrive. And China is likely going to do massive, massive stimulation in its economy once the Fed pivots. If they do it now, their currency and bond market would collapse. So they have to wait for the Fed to pivot, and then they can go into massive spending mode, which is when I think emerging markets will finally outperform. Europe, if it was selling off more than the rest of the indexes, I'd be worried with EFA, but it's not. So we're just seeing pretty even drawdowns in equity indexes across the globe in each continent. In our safe growth strategy, we're betting on uranium with URA. It's outperforming the indexes, only down 11%. We're betting on rare earth metals with RAMX, also outperforming these indexes. Some specific stocks we're just tracking, some of which are in F&G. Amazon down 27%, Apple down 16%, Alibaba also in F&G, Chinese giant similar to Amazon, down 35%. So screaming deals to buy. Chinese PMI is slowing down, showing that inflation should be calming down. Their exports are healthy but not rising. So we can see the demand side globally for Chinese exports is strong, but it's not crashing. And the same thing for imports, trying to get back to those levels last year after a dramatic slowdown from essentially locking down China. All right, guys, that's our core presentation. If you're not a paid member, you're going to get kicked out right now. So call Dean to upgrade at 505-322-7515. Here's our disclaimers, which you can pause and read if you're on YouTube. Otherwise, call Dean at 505-322-7515. We're going to now jump into the membership area for paid members only.